Next concept we have cost concept, and another name is historical cost principle. Here we record our asset like plant and machinery, furniture, whatever it is, recorded in the books at the price paid to acquire it. So that means whatever we pay the amount to purchase that asset will record in the books at that value. For example, suppose an asset is purchased for 5 lakh, and at the time of preparing the final accounts, because the purchase of asset is suppose is purchased on May, in the month of May, and in the books of final account it is recorded at the time of 31st March, and 31st March of next year. Even then the market value at that time is 4 lakh, or maybe decreased or maybe increased, but we will record that asset at its purchase price, that is 5 lakh. So that is why it is called cost concept. We'll record the value at which we purchase it. Then matching concept and matching principles. Matching principles and matching principle, here we have to determine the profit. We determine the profit by matching the revenue and expenses. Matching here means we are comparing, and then we will get a profit or loss. If the revenues are more, then we will get profit, and if the expenses are more, then we will get our loss. So therefore, as per this concept, adjustments made, all the outstanding expenses, prepaid expenses, all such adjustments will be made, and we will compare revenue and expenses. Dual aspect, duality principle. Whenever we introduce the capital, and that capital is equal to cash, equities is equal to assets, 1 lakh and 1 lakh. So whenever we introduce the amount of capital, it is ultimately our asset in the form of cash. So this is the equation. Assets is equal to owner equally plus claims of outside liabilities. And here dual concept means, that means every transactions entered into an enterprise into two aspects. As I explained you, double entry system of bookkeeping, it is based on this principle, duality principle, a debit and a credit of equal amount. Next, 10th point, next is revenue recognition concept. That means we will record the transaction when it is entered into. That means in the month of Feb we sell anything, any item or an enterprise, but we will receive the amount in the month of April. So this is another financial year and this is another financial year, but we will record it in this financial year because we recognize our revenue in this 2017 and 18 financial year. So that is why we record it in the 17-18 financial year, not in the 18-19 when we receive the amount. So whenever the revenue is generated, we will record it in that financial year. Verifiable object concept. Verifiable object concept is accounting should be free from personal bias. Personal bias means personal kind of judgment. So it should be verifiable on the basis of evidences. So whenever we are doing any transaction and recording any transactions, it should be verifiable. Thank you.